Imagine walking into a bank today, opening the wrong type of account, and losing hundreds or even thousands of dollars over time simply because you did not know your options. Sounds scary, right? Here is the truth. Most people in America only know about one or two bank accounts, but there are over a dozen that could completely change how you save, spend, and grow your money. By the end of this video, you will know exactly which account works best for your situation. And stick with me, because in a few minutes I will reveal the one account type that almost nobody talks about, but can secretly help you build wealth faster. Number 1. The basic checking account. Think of a checking account like your financial hub. This is the account where your paycheck usually lands, where you swipe your debit card, and where you pay bills from. It is meant for everyday transactions. For example, imagine Sarah, who gets paid every 2 weeks. Her paycheck goes directly into her checking account, and from there she pays her rent, utilities, and buys groceries. It is her financial engine. But here is the catch. Most checking accounts pay little to no interest. That means while your money sits there, it is not growing. This is why checking accounts are great for convenience, but not for building wealth. Number 2. The savings account. If checking accounts are for spending, savings accounts are for storing. A savings account is designed to keep your money safe and grow it slowly with interest. For example, let us say John wants to save for a vacation. He transfers a small part of every paycheck into his savings account. Over time, not only does the balance grow from deposits, but the bank also pays him interest. The average savings account interest rate in the USA is less than 1%, but some online banks offer much higher. That small difference can mean hundreds of dollars over the years. Number 3. The high-yield savings account. This is like a savings account on steroids. Instead of earning less than 1%, you might earn 4 or even 5% interest. Imagine depositing $10,000. In a traditional savings account, you might make $50 in a year. But in a high-yield savings account, you could make $400 to $500 in that same year. That is free money for simply keeping your cash in the right place. Online banks often lead this space because they have fewer overhead costs, which allows them to offer higher interest rates. Number 4. The money market account. A money market account is a hybrid between a savings and checking account. You earn interest, often higher than a standard savings account, but you may also get limited check writing or debit card access. For instance, Mary keeps her emergency fund in a money market account. It earns her better interest than a regular savings account. But if her car breaks down tomorrow, she can write a check or use a card to pay for repairs without transferring money around. The trade-off is that banks often require higher minimum balances, sometimes $1,000 or even $5,000, to open or maintain the account. Number 5. The certificate of deposit, or CD. A CD is like a locked box for your money. You agree to leave your money untouched for a certain period, maybe 6 months, a year, or even 5 years. In return, the bank gives you a higher interest rate than a savings account. For example, if you put $5,000 into a 1-year CD at 5%, by the end of the year, you would earn $250 in interest. The downside: if you take your money out early, you will usually pay a penalty. This makes CDs great if you have money you know you will not need for a while. Number 6. The joint account. A joint account is shared between 2 or more people. Couples often use joint checking or savings accounts to pay bills and save together. Let's take an example. Mark and Lisa are married. They both put money into their joint account each month to cover their mortgage and groceries. Both of them can access the account, withdraw money, and see where the money goes. It is great for teamwork, but it also requires trust. If one person overspends, it affects both. Number 7. The student account. Banks know students are often just starting out, so many offer special checking or savings accounts with no monthly fees, no minimum balance, and sometimes perks like free ATM access. Imagine a college freshman who opens a student checking account. They can manage their limited budget without worrying about overdraft fees draining their small balance. It is a beginner-friendly way to start banking without penalties. Number 8. The business account. If you run a business, even a side hustle, you need to separate your personal money from your business money. A business account allows you to do that. For example, Jenna sells crafts online. Instead of mixing her sales money with her personal checking account, she uses a business checking account. This keeps her income and expenses organized, which makes tax time way less stressful. Business accounts often come with features like merchant services, payroll processing, and higher transaction limits. Number 9. The retirement accounts, IRA and 401k. Now, technically these are not bank accounts in the traditional sense, but they are accounts you can open through banks, credit unions, or brokers. An IRA, or individual retirement account, lets you save money for retirement with special tax advantages. A 401k is offered through your employer. Here is an example. If you put $5,000 into a traditional IRA, you may be able to deduct that amount from your taxable income. That means you save on taxes today while your money grows for the future. It is like giving your future self a big gift, while also lowering your tax bill today. Number 10. The custodial account. A custodial account, like a UGMA or UTMA, is an account an adult opens for a minor. The money belongs to the child, but the adult manages it until the child turns 18 or 21, depending on the state. For example, grandparents might deposit birthday money into a custodial account for their grandchild. By the time the child becomes an adult, they might have thousands saved up for college or their first car. It is a powerful way to set up kids for financial success. Number 11. The Health Savings Account, or HSA. This is one of the most powerful but most overlooked accounts in America. An HSA is available if you have a high-deductible health insurance plan. Here is why it is special. Money you put into an HSA is tax-free going in. It grows tax-free while it is invested. And when you withdraw it for medical expenses, it comes out tax-free. For example, Alex puts $3,000 into his HSA this year. That reduces his taxable income by $3,000. He then invests that money, and it grows. Years later, he uses it to pay for a surgery completely tax-free. This triple benefit makes HSAs one of the most powerful accounts to grow long-term wealth. Number 12. The trust account. A trust account holds money or assets on behalf of a beneficiary, managed by a trustee. People often use them for estate planning. For example, if a parent wants to leave money to their child, but make sure it is managed responsibly, they might put it in a trust account. The trustee controls how and when the money is distributed. It provides security and structure for passing wealth between generations. Number 13. The brokerage account. A brokerage account is where you can buy and sell investments like stocks, bonds, and mutual funds. While not a traditional bank account, many banks now offer them. For example, if you want to invest $2,000 in Apple stock, you would do it through a brokerage account. Unlike retirement accounts, brokerage accounts do not have age restrictions or contribution limits, but you do pay taxes on gains. It gives you flexibility and access to the investment world. Number 14. The online-only bank account. In today's digital world, many people skip traditional banks and go with online-only banks. These accounts usually offer higher interest rates, lower fees, and slick mobile apps. For instance, Tom uses an online bank that pays him 4% on his savings while his old local bank only offered 1%. Over time, that difference adds up fast. The trade-off is that you do not get a physical branch to visit, so you must be comfortable with doing everything digitally. Number 15. The credit union account. Credit unions are member-owned financial institutions. Instead of paying profits to shareholders, they return profits to members through better rates and lower fees. For example, a credit union checking account might have 0 monthly fees, while a traditional bank charges $10 per month. Many Americans do not realize that credit unions often provide the same services as banks, but with a more personal touch. Number 16. The teen account. Teen accounts are designed for young people, usually between ages 13 and 17, to help them learn money management early. Parents are often co-owners, which means they can monitor spending while giving their teens freedom to use a debit card. For example, a teenager with a part-time job can have their paycheck deposited into a teen account, then use the debit card responsibly for shopping or saving. It teaches financial responsibility while keeping parents involved. Number 17. The payroll account. Some banks offer payroll accounts for employees who want their wages deposited directly without going through a standard checking account. Employers sometimes set these up so workers get faster access to their earnings. For example, If Maria's employer partners with a bank, her paycheck might arrive in her payroll account one day earlier than if she used a regular account. This can be a real benefit for people living paycheck to paycheck. Number 18. The foreign currency account. A foreign currency account lets you hold money in other currencies, such as euros, yen, or pounds. This can be useful for people who travel often, work with international clients, or plan to live abroad. For instance, David works remotely for a company in Europe. By keeping a euro account, he avoids paying high currency conversion fees every time he gets paid. It is a smart choice for global workers and frequent travelers. Number 19. The escrow account. An escrow account is commonly used during big transactions, such as buying a home. It temporarily holds money, like a buyer's deposit or property tax funds, until the conditions of a contract are met. For example, when Jane buys a house, her lender may set up an escrow account to hold her property taxes and insurance premiums. The bank pays these on her behalf when they are due, making sure nothing is missed. Number 20. The zero balance account. This type of account is mostly used by businesses. It automatically moves funds in or out to always keep the account balance at zero. For example, a company might use a zero balance account to pay salaries. Money is transferred from a master account only when payroll is processed. It improves cash flow management and reduces idle money sitting around. Number 21. The joint tenancy account with rights of survivorship. This is a special kind of joint account. If one account holder dies, the other automatically gets full ownership of the account. For example, an elderly couple might set up this type of account so that if one passes away, the other instantly has access to all the funds without waiting for legal paperwork. It is often used in estate planning to simplify access to money during difficult times. Number 22. The charity or nonprofit account. Banks offer special accounts for charities and nonprofits, usually with reduced fees and benefits tailored to organizations. For example, a local animal shelter may open a nonprofit checking account to collect donations and pay expenses. This allows donors to make contributions while the organization manages funds transparently and affordably. Number 23. The specialized savings goal account. Some banks let you open sub-accounts or goal-based savings accounts within your main account. For example, you might create separate vacation, emergency fund, and Christmas shopping savings pockets. This makes saving more visual and helps you stay on track for specific goals. It is like having labeled jars for your money, but in digital form. You just discovered the wide world of bank account types, and each one plays a different role in your financial life. From the everyday checking account to the wealth-building HSA, the choices you make here can literally decide whether you grow money or lose it slowly over time. Now, I promised earlier to reveal the one account that almost nobody talks about, but can help you build wealth faster. That account is the health savings account. Remember, it gives you tax-free contributions, tax-free growth, and tax-free withdrawals. If you qualify, it can be one of the best-kept secrets in personal finance. So here is the big question. If you had to open a new account today, which one would you choose and why?